Humans as we are engaged day in and day out in transaction. We exchange goods and services with one another. It used to be the exchange of goods and services for goods and services. That was the barter system. But we've moved from that system to the cash system, where we exchange goods and services for cash. When we exchange goods and services, there is a need for a marketplace where the goods and services can be exchanged. So for instance, if you are in need of a transportation system or transportation service, you go to, say, a train station or a bus station where you engage the service. If you're in need of physical goods, say clothing, you go to the clothing shop to transact the business. When businesses or individuals or even nations create financial assets, there is a need for a platform whereby these financial assets can be exchanged with one another. So the individual, company or nation that creates the financial assets will exchange these assets with potential investors or people interested in acquiring these assets on a platform called the financial market. So it's nothing more different from the normal markets we know as in Takoradi Market Circle, Aboboloshi Market, where buyers and sellers interact on a daily basis. So it is on the financial market. Buyers and sellers are interacting, and this time in what we call the financial assets. Now, just with our physical markets, I made mention of Takoradi Market Circle because I'm from Takoradi, so I'm tuned to Takoradi. You could engage in the trade of, say, food item, or you could engage in machinery, you could engage in clothing. These are different classes of items you can engage in. On the financial market, there are also different classes of assets one can engage in. One, which is a popular one, is what we know as the equities. So let's consider a business, maybe a production firm that wants to expand its production process. Oftentimes, the business may not have enough cash that they may need to drive their production process. So to do this, what the business does is they are going to sell a stake of the business to people who are interested in acquiring some stake in that business. So like a piece of, like a cake, they cut the business into pieces whereby they sell piece of that cake to investors. And when people buy that piece of cake, they become co-owners in the business, and as such they are entitled to profits that the business generates, as well as loss that may occur in future time. So that asset class is what is known as equities, where people buy ownership stake in business. So that's one thing we could engage in the financial market. On the other hand, we could engage in what is called the bonds, which is a debt funding. With the first example I talked about, the company chose to go the equity direction in its financing process. The company this time, in deciding to expand, may choose not to go the equity direction, but may go for a bond debt option. Basically, they are borrowing money to drive the expansion processes. But you know that when we borrow money, for instance, if I lend money out to you and I need the money before the time is due, I may not be able to do anything about it. I'll just have to wait till the time is due. And even when the time is due and you're unable to repay, I can at best take you to court. But beyond that, I may not be able to do anything about it. But businesses, when they lend out, they want to be able to get their money back should they be in need of the money before time. And also they would want to be able to get their cash back should the debtor not be able to pay at the time. So they engage in what is called the securitized debt. So basically they convert the debt into a form that can be traded, so that if I need my money before time, I basically sell that debt to another person who is interested in acquiring that debt. And if my debtor is unable to pay at the time where the debt is due, I can equally sell that debt to somebody who doesn't mind holding the debts for a longer period. So businesses, individuals, and even nations create those debt options called the bond, where they basically borrow money from people to drive the production process. So we see, for instance, our nation Ghana launching out a bond option. So it's basically Ghana government borrowing from people to be able to carry out whatever projects they want to do, and people engage or buy some of these instruments as a way of playing the financial market. So that's the bond is the second financial instrument we can engage in. There is also another asset class called the commodities, and when we talk of commodities, we are basically talking about anything that be obtained from our environment, the natural resources. So for instance, we have gold, or the precious metal, gold, silver, which can be extracted, and we deal in the exchange of these precious metals. We have the crude oil, which nations deal in it, businesses and organizations deal in. So all these items come under one asset class called the commodities. So we can be buying and selling these commodities on the financial market as well. Then aside the physical items like the gold or even the crude oil or even the share, apart from buying or selling these physical items, we engage in what is called the contract for differences. So basically it's like a trader who travels to China to bring some clothing to sell. Maybe he goes to bring the item for $1,000, he's able to sell it for $1,200 on the market, making $200 profit. Then we come to the person and tell him, why don't we do a deal whereby this time you wouldn't have to travel to China, looking at the risks involved in traveling and all that, the stress and all that. Don't travel. Let's just set a contract and fix the value of the contract at the price you would have gotten the item if you had traveled to China. Now when the item prices rise, just like the person going for the physical item, and it rises to 1,200, so that the person sells it for 1,200, making 200. When this item, underlying item price rise, then I'm going to pay you the difference between the contract value and the market value. And if the price should fall, that is going to be your loss. Just like you going for the item for $1,000, but you come and the market price is low, so you're able to sell. You sell at a loss to incur that loss. We could engage in the trade of contracts of the various instruments called the CFDs. So if it is commodities, you may not engage in the physical buying or selling of gold itself, but you may engage in a contract of the prices of gold. So as gold price rise and fall, you could make money on it or loss from it. I made a mention earlier that the financial market is similar to, say, market cycle or macular market, but there are a couple of differences in the sense that with the normal markets, first of all, the normal market we engage in is what is called the product market. It's a product market because it's a market that deals in the products of the results of production, the produce, all right? But the financial market is called the factor market, which has to do with the factors of production. Now in the product market, usually the buyers and sellers engage directly in the activities. So for instance, if you go to Takoradi Market Circle to buy something, you are going to engage directly with the tomato seller who has come to sell her tomatoes. But on the financial market, the trade between buyers and sellers is usually done through a middleman or a connection man, as we usually say in local parlance, called the broker. So if you want to buy any financial instruments, you don't walk into it just like you walk directly into Takoradi Market Circle. So imagine Takoradi Market Circle with a bouncer at the gate who says that if you want to buy, give me your order, then I'll go and buy for you. Likewise, if you've come to sell tomatoes, give me your tomatoes, then I'll go and sell for you. That is the financial market. Transaction is done through a middleman called the broker. So sellers will now give their selling order to the broker to connect them with buyers who also give their orders to the broker. Now, another difference in the financial market compared to the product market is that usually with the product market, the sellers sell things they own. So you come there to sell things you have acquired. But then on the financial market, we have a concept called short selling, where you don't have to have that stock, but you still sell it. So for instance, this morning when I was coming, I entered into a short sale on gold. I don't have gold, I don't have any gold, but I managed to sell it. And basically how it works is you going to buy, say, a shirt from the product market, you describe to the person, I want this kind of shirt. And the man will tell you that, oh, I've run short of that product, but you wait, I'm going to get one for you. Then the person runs to probably borrow from a fellow seller who has that item you want, and then comes to sell to you. All right. So on the financial market, we engage in short selling. Basically, we borrow the item we want to sell from the broker and then sell it. And we do so hoping that the price of it will come down. Then at the end of the day, when the price goes down, we buy it back at a lower price for the person, making that profit. So that is another difference on the market. Then finally, we have what is called the leverage product. So unlike the fiscal markets, where if you are buying $1,000 Ghana worth of tomatoes, you need to put up 1,000 Ghana. On the financial market, you don't need to put up the entire value of the item you want to buy. The broker will just demand you to put a certain percentage, which we call the margin. You put up the margin, and the broker will allow you to do business as if you had put up the entire value. So that's some of the key difference between the product market and the factor market. So the key reason why most Ghanaians favor the fixed deposit option has to do with our nature. Ghanaians are generally people who are risk adverse. That is, we generally fear risks. So we like to engage in businesses that has low or no risk, if I may put it that way. So you see a lot of Ghanaians going in for the fixed deposit option. The second has to do with the rates which we get on our fixed deposit market. Unfortunately, the role of central banks in controlling inflation has to do with the adjustment of the interest rates on their treasury bills or treasury notes. Unfortunately, here in Ghana, the central bank does not engage in the adjustment of interest rates as a way of controlling inflation. Rather, it's a way in which the government tends to borrow more money from the individual, so that we tend to pay higher interest on our fixed deposits as a way of they getting more money. That really cripples the economy, because if I can comfortably get over 20 plus from a fixed deposit deal with the government where there is virtually no risk, why would I bother taking on the extra risks to do an equity deal where I will get something like 30%? So as long as the interest rates paid on treasury bills and treasury notes are quite high, people will flow more into the fixed deposit option. And we saw the banks even engaging in that. So instead of giving loans out to businesses to grow, they prefer giving the loans out to government at a high rate of interest. And at the end of the day, there's little risk on their balance sheet, and they are still making more money. So I think the direction of government reducing the interest rate is something that personally I'm in favor of. It's going to force people to now pump money into equity investment, whereby businesses will get money to grow. It's going to force banks to pump more loans to businesses and individuals to expand the productivity base of the economy. A great question. When do we buy or sell? All right. So let's say your phone is currently valued at 1,000 Ghana cedis, and for whatever reason you have information that the price of the phone is going to go up to say 1,500 by tomorrow, and you want to make money from this information, because the financial market is all about information. All right. So having information that the price is going to go up, what you can do to make money is that you can buy some of the phone now for 1,000 Ghana and wait for the price to go up. So if the price shoots up to the 1,500, you could sell the phone that you bought for 1,000 Ghana for 1,500, making 500 profit. So the more price appreciation the phone gets, the more your profit. That is what we do on the financial market. Whenever we have reason to believe that the price of any instrument is going to appreciate, or there is bullish pressure, as we call it, bullish because the animal bull strikes from low upwards. So when we perceive bullish pressure in the market, we buy the item at a lower price, so that when the price goes up, we can now sell the item we bought for a lower price for that high price, making that difference. In a likewise manner, when we have reason to believe that the price of anything will go down, so back to your phone example, let's say that your phone is now 1,000 Ghana, and you have reason to believe that the price of your phone will go down. maybe you had a dream, somebody visited you in your sleep and told you that the price will go to 800 Ghana. What you can do to make money from this information is that you could go and borrow that item, which is valued at 1,000 Ghana, from anybody who deals in it. Then you sell that item now for that 1,000 Ghana and wait for the price to go down. So if the price should go down from the 1,000 to that 200 to that 800, sorry, you could now buy back the item you sold for 1,000 for the 800 to return to the owner. Then you make a profit of 200 Ghana. So whenever we expect the price of anything to go down, we engage in what is called the short selling. We borrow the item now and sell for a higher price and then wait for the price to go down. So with my gold example, I had reason to believe that the price of gold will go down. So I borrowed gold and sold now, waiting for the gold price to go down. And if it decreased to any percentage that I want, then I could now sell, buy back the gold I sold for a higher price to make that profit. And the market, like the human system, you know, the human body, if you are healthy, there are certain vital signs your body will show. So your pressure will be in a certain range, your thermometer, your temperature will be in a certain range and all that. When you go to the hospital, the doctor will now do an analysis on your various organs and compare it to the normal vital stats of a healthy person. And whenever any of them has gone out of the normal range, then the doctor will conclude that because of A, B, C, D, maybe you have malaria or you have typhoid or whatever. Now there are certain instruments we are able to use to measure, in quotes, the vital stats of the market, its temperature, its pressure and all that. And when we measure these vital stats of the market, doing our analysis and conclude that there is bullish pressure, that is, there's a propensity for the prices to rise, we then buy the item. And when we expect that the price will reduce or there is bearish pressure, we then short sell the item to make profit. So that's how we make money on the financial market. Obeams Cap is our managed account service that we run at Obeams Capital Management. With the traditional investments, we have an investment company pulling funds together from various investors in a brokerage account. They then do business on that account, and at the end of the day, whatever profit that has been made is then shared with the shareholders of that account. Now with Obeams Cap or the managed account, the client is afforded opportunity to have their own brokerage account, just like what the investment company have. So in effect, you are having your own pseudo investment company. But then we at Obeams Capital Management will take over the management of the account. Take over, not that we are taking your cash or taking your account for ourselves, but basically once the account is created for you, you do the funding yourself. We don't come into the direct handling of the cash. You deposit cash into it directly with a broker, then we take over the decision making of the account as to which investment to go in, when to buy or sell any of the financial instruments. We do our thorough analysis with the help of our research team to analyze and to know which markets to go into, what to buy and what to sell at what time. We engage in some of the asset class I made mention of earlier on, be it commodities. So we have the silver, gold, palladium, crude oil. We engage in those activities. We engage in equities and its index. We also engage in an interesting asset class called the forex, which is the currency paired against the other. So for instance, the appreciation or depreciation of the value of the pound against the dollar, or the dollar against the yen, the euro against Chinese yuan. We engage in all these transactions. Once we do our analysis and know that there's going to be price appreciation, we buy that instrument. And when we know that there's going to be a price depreciation, we sell that instrument. Now, we are not oblivious to the fact that there is risks in the market and that we cannot be 100% right in our analysis. No matter how good our analysis is, we give room for error. So we have a strong research team and risk management team that calculates how much of the client's fund we want to expose to a trade. By principle, we don't allow clients' account to be exposed more than 3% on their fund balance. So if you have a client signing up with a minimum of say $1,000 and funding that account, our research team and the risk management team will make sure that for every trade that is placed, that account is not exposed to more than 3%. So that means that if the trade should go against us, the maximum we can lose is 3% of the fund balance. We set in what is called a stop loss, so that once the trade goes against us to that percentage, our system automatically shuts down the trade to preserve our client's capital. And we're able to calculate as well how much we can enjoy on the trade in terms of riding on the trend. So once the trade gets to our profit target, our system automatically shuts down the trade so that we lock in that profit. And I must say, with the help of our research team and the risk management team, we have been able to, over the years, get good returns on our investments, as well as preserving the maximum exposure on our client account. And I'm very, very grateful for how much profit we've been able to make for our clients, because they are the reason we exist. For every dollar our client brings, we believe that it is the hard-earned money. So our job is to make sure that we bring out of that $1, which is like a master seed, to bring out of it that great tree using our thorough research analysis and risk management.